Welcome to chapter 10, where we're going to be covering the main topic of depreciation. But we'll see more depreciation rules and amortization and depletion in part 2 of the next video lecture. But let's distinguish the three different groups here, yeah? Sometimes it's called cost recovery. So let's take a look at the type of asset we have here. So the first group applies to property, plant, and equipment. Or sometimes they call it fixed assets. And instead of the name, let's actually do journal entries. Or in fact, maybe adjusting journal entries that you do at the end of the period, like you learned in your financial accounting class with debits and credits. So in the case of property, plant, equipment, the name of the expense is depreciation expense, something that you've probably heard a lot of in previous accounting classes. And you all guys remember the account we credit, yeah, accumulated depreciation, that contra asset. And the calculation, really not the detailed numbers, but the name we use. Sometimes we call this Modified Accelerated Cost Recovery System, or MACRS. But specifically, it's the double declining balance method. Or if you want to take your depreciation over a longer period of time, instead of double, 200%, we take 150% declining balance. Or maybe even slower than that, using the straight line method. Or if you think that the units of activity method is more reflective of how fast you can depreciate this asset, then maybe you can use this method. But the most common, especially for um, prop plant, not plant, but the equipment, would be the declining balance. We'll see that straight line has to be used for real property, except, remember, land is not depreciated. It just sits there on your balance sheet. It just sits there in your ledger until you sell that property. Okay, so that's property, plant, and equipment. Another type of asset we have are intangible, things like copyright, patents, maybe startup costs, organization costs, things that we will amortize. Debit amortization expense, credit contra asset accumulated amortization. And the calculation would be straight line. Now, the life of this intangible asset may vary depending upon what code section the asset falls under. But generally, the calculation is the costs of the asset divided by the life, or the straight line method. So we'll see an example in the next video. Let's talk about something that's not common as a deduction for businesses in Hawaii, and that's natural resources. So typically you're talking about stuff like oil wells, gold mines, standing timber, and they would claim a depletion deduction, or um, let's see, crediting a accumulated depletion account. Yeah, a depletion allowance. And the calculation would be the units of activity. When you extract a barrel of oil, or mine a ounce of gold, or so many yards of timber, you're going to debit an expense. Or if you extract it and hold it, then maybe you're going to be debiting inventory for sale and crediting the allowance here. Okay, not common in Hawaii. These two definitely common for businesses in Hawaii. Okay, and we'll take a look at um, in this chapter really the MACRS calculations, the MACRS rules. So some general rules regarding depreciation. It applies to assets for trade or business, or production of income. Remember, whenever you hear this phrase, production of income, think rental property. You're a landlord. So here's the building that you're depreciating. Here's the furniture, the equipment in that building that you're depreciating. You cannot depreciate any assets you use for personal use in your life, like your personal automobile, like your computer that you use for schoolwork. That's not a tradable business. That's not production of income. You cannot depreciate those assets. When do you start? Well, here it also mentions land is not depreciated. Even works of art, technically maybe they appreciate versus depreciate, yeah, but you cannot deduct that cost until you sell it. So you start depreciation not in the year that you buy the asset, acquire it, but when you place it into your business, into service, when you start using it in your operations. Only then you get to start depreciating that asset for the rest of its life you use it until you either get rid of it or it's fully depreciated. Okay, so know the difference between these two words here. Allowed means the deduction that was actually claimed on the tax return. Allowable means what you could have claimed but probably didn't. We know that the cost of an asset, here's the cost, minusing out the accumulated depreciation equals something called book value, or in tax terminology, it's called adjusted basis. So here's all the prior depreciation that was claimed. But you know what? You gotta put here what also should have been claimed if you didn't claim it. Now, if you sell it, here's the sales price, and you minus out this basis to get either a gain or loss. If you have to put in here what you could have claimed but didn't, you're going to have a bigger gain or a smaller loss. You're going to lose out on that depreciation that was not claimed. But that's the rule. You gotta reduce this or increase this accumulated depreciation by whatever was allowed. Maybe you even took too much. You gotta put that amount down. Or what was allowable. If you didn't claim it, you still gotta put it down. Reducing the book value, increasing the gain, or reducing the loss. Now there are mitigating procedures you can do to maybe claim any depreciation that was not claimed at the time you sell this asset or at the time you discover there was a mistake in prior years. Either by amending the prior year returns if the years are still, the statute is still open, or possibly changing the method of accounting. I believe you have to file a form. I would have to double check, but I think it's Form 3119, where you say that you're going to claim in the last year where you own this asset any depreciation that you didn't claim in past years. I have a link in our La Lima resources folder for chapter 10 regarding this situation in case you come across it. Again, the main type of depreciation we'll do in this first part 1 video is the modified accelerated cost recovery system. But another calculation of depreciation is called bonus. Another type is called Section 179. And these two we'll see the rules and the calculations in part 2, in the part 2 video. There is another rule regarding claiming at least relatively small assets as costs. And I don't see it in our textbook. It's called the safe harbor, this Latin word, de minimis election, where depending upon whether you have a large or small company, whether you have to prepare financial statements or not, maybe you can claim up to $500 per purchase item. Treat it more like a supply than a depreciable asset. Treat it more like a maintenance expense, yeah, versus a capitalized cost. So I have a link in again our La Lima resources folder regarding the safe harbor de minimis election that's not mentioned in our textbook. So here's some more terminology. Tangible, stuff you can touch, are depreciated under the MACRS rules versus intangible assets that the company owns, that your business owns, that have to be amortized. Again, we'll cover amortization in the part 2 video. Real estate, real property, usually has to be depreciated using the straight line method. And again, remember, you don't depreciate the cost assigned to the land, just the improvements on the land. And personal property, maybe stuff in the building, stuff not attached to the land. Um, we'll see the maker's calculation for this. We generally have two types of costs. Costs that you treat as an asset and costs that you deduct as an expense. If you treat it as an asset, maybe then eventually you can convert it, depreciate it into an expense over its lifetime. Yeah, but you have to know the rule, yeah, in terms of whether capitalized costs, or sometimes they call this revenue expenditure. So let's say that you buy a personal use asset, and we've seen on the previous slide that you cannot deduct this, you cannot depreciate it. But maybe later on, you convert this into a business use or production of income use. At that time, you look at the original costs when you bought it here, and you look at the fair market value at the time of the conversion, and you pick the lower of the two to use as your depreciable basis for business purposes. Here's the main topic again, yeah? Um, Quite a few years ago now, there used to be something called accelerated cost recovery system. And then they modified it. And that's what we have right now, the MACRS system, which tries to make the calculations more objective. Not necessarily simplified, but more objective. And one way to do that is to get rid of estimates. And here is an estimate that we had made in previous accounting classes in calculating depreciation. Well, no more salvage value. In other words, you just ignore it, zero salvage value. You get to depreciate all of the costs. Okay, so more objective calculation now. We do have to assign assets into something called class lives. And really based upon older rules, class lives is just listed, assets are listed by class lives on a table, which is summarized here in our textbook on page 5. So here's all the different class lives. For example, in a 3-year class life, they have tractors. I guess there's a lot of wear and tear on tractors, so they're going to just estimate it. Everybody has to use this estimate of a 3-year life. Maybe you have a real junk one you just bought that won't even last a year or so. You still have to use this objective 3-year life. Even racehorses. Maybe your racehorse is slow and you don't want to race it anymore. Well, you only get to deduct it over 3 years versus its natural racing life. Here, even a real long life for a racehorse, still 3 years. This marginal note says the 7-year is probably the most popular. I would think though 5-year because it includes automobiles and trucks and computers, stuff a lot of small businesses use. The 5-year life, class life is very popular. And then the 7-year class life that includes equipment and office furniture. I think these two are the most popular. Less popular is these longer lives. You have to kind of fall in certain types of industries to fall here. Okay, so pretty objective. You're probably going to fall into one of these class lives. You don't just make up now your life. When you hear the word convention, Think in terms of a calculation in the first year you buy the asset, you place it into use, and also in the year you dispose of the asset if you don't hang on to it for the full class life years. In the first year, you probably are going to take just a half year's worth of depreciation, even though you held it for close to a full year or very little than a year, or maybe of just a few days. The assumption is you own it for half a year. There's exceptions to that, and we'll see that. Yeah. Also, when you dispose of an asset in the year dispose of it, you're going to take half of the depreciation rate that we'll see that's listed on the table. The table assumes that you've held the asset for full years, but in the year you dispose of the asset, you still use that full year rate, and you take half of it no matter how long you had the asset in that disposition year. Okay, so that's convention. First and last year, special additional calculations. So if your asset you're depreciating is tangible personal property versus real property versus intangible property, the general rule is that you use the half-year convention. Half year's worth of depreciation in the year you first place it into service, and a half year's worth of depreciation adjusting the amount on the rate from the tax table in the year you dispose of it. Now, if that tangible personal property, a lot of it is bought in the later part of the year, really in the last quarter, then you have to use a different convention called mid-quarter. So let me illustrate that by a timeline. So here's the end of the year, December 31st. Here's our beginning of the year, and we divide it up into quarters. So here's the beginning of the second quarter. This is April 1st. Here's July 1st. Here's October 1st. So the rule is you generally, no matter when you buy the asset during the year, you use the half-year convention. Unless more than 40% of the assets you purchase, that's really tangible personal property for the year, more than 40% is placed into service in this last quarter. If that's the case, you're going to have to use this mid-quarter convention. So any assets placed into service in this first quarter is assumed to be depreciated from the middle of the quarter to the end of the year. Anything placed into service in the second quarter is assumed to be placed into service in the mid-quarter to the end of the year, and likewise for all 4 quarters. So now, instead of assuming everything for the whole year is placed into the middle of the year, now we have to divide up the purchases, really the placed in service assets by quarter, and have a calculation for each quarter. Again, that's assuming you, I guess, backload the purchases more than 40% here in the end of the year. And the mid-quarter doesn't just apply to this last quarter, it applies to each of the 4 quarters if this fourth quarter has more than 40% of the year's purchases, or again, placed in service for personal property. So here are the things that we go through to calculate the depreciation under the MACRS rule. You have to know how much costs to capitalize. Okay, and again, no salvage value, so you're going to deduct all of this cost over the asset's life. The default, the general rule, is to use the double declining balance method, and this is already built into percentages, depreciation rates on the depreciation table. You could elect to depreciate slower using 150% declining balance or straight line, and I believe there are tables, depreciation rate tables, to do this also, but this is the default. We've seen class lives, remember that 3, 5, 7, and so forth. Yeah, you have to fall under. And for each class life, we'll see a column in the depreciation table. Convention default is the half year already built into the table. If you have those more than 40% of the tangible personal property put into service in the last quarter, then you have to use the mid-quarter convention. And there's special depreciation tables for that, for each of the 4 quarters. So we take the costs and we multiply it by a rate depending upon the class lives to get the depreciation for the year. The cost will stay the same every year unless you get rid of the asset, but the rate will change. Again, we're looking at the rates on the depreciation table going down for each year. So I want you to download, maybe even print out the depreciation tables in Appendix C in our ebook. So you go to the appendix and you can navigate through the different pages by using the next or previous button, or this big buttons here, next or previous and next, yeah. And you actually can print it out, at most 10 pages at a time. Definitely, save it as a PDF file. But you see this table 1, I actually printed out on paper because I used it a lot, especially for the dynamic study modules for this chapter. Okay, so now you can also navigate through other pages in your textbook and also see this table at the same time. And you can see, well, let's take a look at the downloaded table 1 here. So this is made for personal property using the half-year convention and defaulting to the double declining balance method. And here's the class lives in this columns here. So if I have a 5-year class life asset, in the first year, I'm going to take a 20% depreciation deduction. That same asset, I'm going to take a 32% deduction in the next year. You notice there's like 6 years here for a 5-year. The reason why, because the half-year convention assumes half a year's worth in the first year and a half year's worth in the last year. Let me go through a 20% here. So let's assume that there is a $100 cost. Excuse me. And we would divide this by 5 because that's the life. But we take double. That's the 200%. But the convention is half year in that first year. So I multiply by half. These two will cancel out each other, leaving me just this dividing by 5, which is the same thing as multiplying by 20%. And then it gets bigger because there's a full year next year, but the declining balance eventually gets smaller and smaller. Notice how these rates look the same. These rates are kind of the same. Over here in the later years, the same. What's happening is that it's switching from a declining balance to the straight line method when the straight line method is larger than the declining balance. And it's not straight line like the way you learned it in previous accounting classes. It's taking straight line from the adjusted value here, the book value here, and deducting it evenly over the remaining life. Except again, you have a half year, a half year's worth in the last year. Okay, so 1, 2, 3, 4, 5, 6. This is really 5 years spread over 6 years because half year up here and half year down here. Like this would be 8 years. 7 years spread over 8. So here's an example. We have Mary purchasing just in March, so none of that 40% rule apply for the last quarter. 20,000, 7-year life for a machine. We're not taking any section 179 and bonus that we'll learn in the second video. So all we do is take the cost, same cost every year, and multiply it by the rates, these two rates you see over here. First year, second year, and so forth. Yeah. If you total up all the percentages, it should equal 100% for every one of our columns. So again, you're fully depreciating the asset. No salvage value. Let's look at another example. This time we have Michelle purchased a machine a few years ago, 2013, a 7-year property. Cost was 100,000. No Section 179, no bonus. We'll save that for the next video. And then she gets rid of the machine, sells it in 2017. We always have to take depreciation all the way up to the point of disposing of the asset. So we did it back in 2013, 2014, 15, 16, 17. Now we're selling the asset here in 2017. That's 1, 2, 3, 4, 5, the 5th year. So if I go back to that depreciation table, 1, 2, 3, 4, 5, this 8.93 in the table assumes that you held the asset for the full year. But under the half-year convention, remember we adjust the first year, which is built into this table, half year, and the year you dispose of it, which is not built into the table. So we got to adjust this 8.93 rate. This 8.93 is a full year. So when you look at the calculation, here's our costs, same costs we've been using for the past years. And here's our rate for 2017, but that's a full year. Even though we've held it up through for most of the year, you still take a half year under our half year convention. So the depreciation we take for 2017 is this amount here. Yeah, you multiply all of this out. If you apply the mid-quarter convention, you may have to use 4 different tables. This is not the same as the half year, yeah? This is the first quarter of the mid-quarter. So any asset purchased from January through March, the first quarter, has to use this first quarter table. Anything purchased from April through June has to use the second quarter. Here I have the fourth quarter. We use these real low rates because you didn't have it for most of the year, right? When you buy something in the last quarter. The middle of the fourth quarter, October through December, you use these rates. So another example, Fur Corporation. They bought a total of $1.72 million of tangible personal property that's going to be depreciated. Again, no 179, no bonus. So if you add all of this up, you get that total. But notice the dates here. First quarter, second quarter, fourth quarter. This amount here is greater than 40% of the total. So we gotta use the mid-quarter convention. So you have the costs, and you multiply it by the rates that you find on those 3 or 4 different mid-quarter convention tables. Again, this would be the first quarter, this would be the second quarter, and this one would be the fourth quarter. Let me just show you this 5% for, what is this? Is it 5 or 7-year property? 5-year property. Here's the fourth quarter, 5-year property. The first year we bought it, 5%. Yeah, 5% here. And you keep on using the mid-quarter tables for these 3 assets for the rest of the life you own them. Again, every year you have to apply whether it's a half-year convention or mid-quarter convention for the year, for the assets you bought for that year. Let's take a look at depreciating real estate. We have to divide real estate into 2 different categories. Real estate where people live. This is an apartment. This is a condominium, a single family home that's rented out for them to live. And it has a shorter life than non-residential real estate. Here's an office building. Here's a barn for a farm. Here's a warehouse that will have a longer life. The method we use in calculating depreciation is not the double declining like we saw for the tangible personal property, but we use the straight line method. And we don't use the half year convention. We don't even use the mid-month, mid-quarter convention. We use mid-month. You identify real estate by the month you purchased it in. Here is a depreciation table for residential rental using this 27.5 year life with a mid-month convention straight line calculation. And this 12 represents the different months of the year you bought the asset. So let's say you bought something in our current month of November. And the first year, here is the depreciation rate. Keep in mind, this is a percent. So if you convert this to decimal, you're looking at 0.00455. And this is 0.45%, decimal 0.0045455. Again, no salvage value. Make sure you're not depreciating any land costs. Here is non-residential, 39-year, straight line method. Notice most of the years it's just using the same rate. Oh yeah, and once you identify the month, you got to stick with the same column for future years for that property. Yeah, so that example I just showed you here, this is the first year. Well, this is going to be the second year, the third year. You got to stay with that same column. Notice it's real close, again, because it's straight line, but there's some rounding. You see the difference here due to rounding? Okay, so this is non-residential. Let's take a look at an example. Here is non-residential, an office building. We have a cost of the whole property of 1.5 million and 200,000 is land costs. So what's depreciable is what's allocated to the building, the improvements. And in the first year, for purchasing in October, let's see, that's 0.535 right here, yeah, 0.535. And now you got to use this column for the rest of that asset's life. Just multiply depreciable cost times rate, depreciable cost times next year's rate in that same column on the depreciation table. Let's stop here. When you come back, take a look at the part 2 video where we talk about more specific depreciation rules and the calculation for amortization and depletion.